And with that, I think I am ready to introduce our panelists. Yes, all right. So I'm thrilled to welcome back Steve Sharpe, Senior Attorney at the National Consumer Law Center. Steve focuses on foreclosures and mortgage lending and has been a trusted expert and our good friend to housing counseling community for years. He's our go-to on all things FHA and is a strong advocate for housing counseling and always one of the most popular voices on our webinars. So we feel really lucky to have him with us today. And then Nguyen, who is the founder and CEO of VAREP and the USA Homeownership Foundation, a HUD-approved housing counseling agency. Sun is a proud Navy veteran, and he established these organizations to help service members and veterans achieve stable homeownership. Today, Sun is available to answer questions about the VA partial claim and other loss mitigation options. And then, as I mentioned earlier, he'll join us again next week for our webinar on the military veterans counseling certification. And with that, I'm going to hand it over to Steve.
Well, thanks everyone. Thank you, Ellie and NHRC. And just want to re-plug uh, the story bank. Don't be shy. You all do incredible work. You save not only homes, you do that, but like Ellie said, you also save the government, insurers money when you do your job as you do well, and that is avoid foreclosure. And when you avoid foreclosure, that's not just a saving to the servicer. It's not just a saving to the homeowner. Of course it is, but it also does save the government money. And I think at this very tough time, appreciate all of you out here and just would encourage you all to not be shy. I'm really glad NHRC has that storyboard, and I think you should share your wonderful, wonderful work. So that said, now we are going to talk about policy. There is some policy updates. And I'm going to share my screen and run the slideshow. This is really a part two from what we talked about in July when I was last on. And it's going to focus, I think, as you said, on kind of two main areas. First, I'm not running this slideshow. Play from start. There we go. There we go. First, we are going to update you all on the situation at the VA. When we scheduled this webinar, I think we were hoping for more clarity. We don't have a lot more clarity, but I would like to update you on the good news of the passage of the VA partial claim bill with the flag that it has not been implemented yet, which I know I've heard from a lot of you that, of course, is frustrating. But I do think it is worth, at this time, reviewing what's in there and sort of looking to the future of what is coming down the line, hopefully, especially when the government hopefully reopens. And then Son will jump in, of course, and share his thoughts. A lot of great experience in this area. So after we've moved through VA, what I want to do is answer some of your questions out loud. I'm pulling from questions you all had on our last webinar about the FHA waterfall, because some of them are so good that it's better for me to have prepared them. And so I will sort of walk through some of the guidance and kind of answer your questions in depth. We will do a little refresher about the waterfall since it has changed. And they have just gone into effect. And so we're going to do our best. And of course, how they are actually implemented really matters. And then we will take some time to answer your questions live. But I prepared some answers. And if I can't answer some of your questions live, I'll probably do the same thing, which is go back, look through the guidance, and figure it out. Your questions really do help me and everyone understand what we are reading better. And so if you still have questions after all that, there's my email. I love hearing from you all. You have great questions, and happy to do that. Okay, so Ellie, feel free if there's any point you need to interrupt, go ahead. We will take we'll take a full pause at the end of the VA section though, and that could be a good time to deal with what comes in as well. Okay, let's do this. So we'll start with the current status of VA loss mitigation, and importantly, the passage of HR 815, which is the VA Home Loan Program Reform Act. And again, if there's one thing that you really need to take away from the webinar, it is that we have a solution to the gaping hole in VA loss mitigation passed. Unfortunately, the VA needs to implement the program through regulation and guidance, and I have no way to predict that. So it's good to know, but the takeaway is that unfortunately we are still waiting on the solution coming through. But let's do a reminder about what we've been through. So basically, as you all know, the federal agency, the federal investors all have loss mitigation systems that were significantly tested in 2022. And unfortunately, we have to go back to 2022 because we are still dealing with cases that are that old. But the problems really started at the beginning of 2022 when the interest rate on mortgages increased dramatically. And I think if we talked about when interest rates increase, especially for VA, FHA, and USDA loans, that not only impacts the origination mortgage rates, but it also impacts modification interest rates. So, and you all have seen over the last few years what this has meant for people with low interest rate loans getting modifications that I've seen triple, often double, often dramatically increase. So this interest rate increase has really changed the effectiveness of loss mitigation over the past few years. But what happened with VA specifically is we didn't have a partial claim program that, and we'll talk about what that means, but basically to preserve the borrower's pre-hardship payment, at least leave that option open. So what we hope is a system where we can either decrease the payment or hold it steady depending on what the borrower needs. But for VA, we had loss mitigation, loan modifications that weren't working well, and we had no partial claim program because theirs expired. Their COVID partial claim program expired in October of 2022, and that left a gaping hole for veteran borrowers facing foreclosure. I talk about that in detail in this testimony to Congress from a couple of years ago, if you need more information. So then we had about a 2-year gap of nothing really going and people really suffering. And in fact, it was so bad that we had a moratorium on foreclosures, and something that is just still shocks me that it was tolerable and should be tolerable. But during that period, the options for veteran borrowers were way less favorable than the options available to other federally backed borrowers. And by veteran borrowers here, I mean VA guaranteed borrowers. And that was really a horrible situation and caused a lot of hardship. Now, we did have a solution briefly. And starting in October of 2024, there was VASP, the Veterans Affairs Servicing Purchase Program. It did not become mandatory until October 1st. So you did have this like 2-year window of really hard stuff happening. But VASP, which involved VA buying loans from servicers, really has proven, if borrowers could have gotten it, to be a pretty good fill for the gap that was there. However, And some of this we've talked about. Only 6 months into the program, we had rumors, or at least pretty credible information, that VA was canceling the VASP program. And in fact, after between the time between announcing cancellation and the actual cancellation was very, very short. April 3rd, it was confirmed to NPR that it was being canceled effective May 1st. So, what is that, 27 days? Not much. And then we didn't even get the details of the cancellation until April 23rd, 2025. We were all scrambling like crazy. So I think so. So that's sort of where we were. And when you cancel VASP, you then return to the situation we had going in, which was VA borrowers with substantially worse options available than other federally backed borrowers. And so there was this, and there kind of still is this sort of now divide between those borrowers who maybe got in the queue for VASP and now everybody else. So this is important, I think, to review, because I think many people are still seeing borrowers who are in somewhat of the process of VASP, or borrowers, and I'm happy to chat with you about those cases, who maybe think they should be in the queue for VASP. But one thing I think is important is understanding the circular, because the circular that VA released to provide the details kind of does give us a roadmap of where, at least from a time perspective, some of these folks are. So when they announced this, VA said, okay, you had to get in by May 1st, but we were going to allow active trial plans to continue through August 31st, 2025. This was going to be subject to a determination of funds available. I haven't heard that be the issue, but in other words, VA funds. But of course, we're in with the shutdown. It's hard to know exactly what's happening. But so the trial plans were to continue, if you needed a trial plan, through August 31st of 2025. The submissions, though, had to be in by 11:59 on April 30th. So, there is this question of, did they servicer submit to VASP? Should they have submitted to VASP? But in any case, they needed to, if there was going to be a trial plan, to be done by August 31st, 2025. So you had to get in the door by April 30th, and then trial plan complete by August 31st. And my understanding of the situation now is you have a bunch of these loans where you've met these categories, but they have not been transferred yet to VA. And of course, the shutdown is affecting that. So I would be curious, and I don't know that we need to talk about these today on the call, but I would be interested in hearing any stories you all have about cases that are in limbo right now. I've talked to some people who we've talked about whether they could have gotten in the queue or not, but now I think it is, how is the are there delays in actually finalizing these modifications? I would be interested in hearing your stories there. So now, so that's that interesting pool of people who maybe could get into VASP. And again, VASP is that VA purchase of the loan and a reduction of the rate. So now for borrowers now, if you have someone who did not get into the VASP queue, the other thing they did was discontinue the waterfall they had put out. So VA had a waterfall of options. For those of you who are new at this, waterfall means the ordering of options available. How does a servicer decide what the borrower should get? So we had VASP and we had a waterfall, But then in the circular, they discontinued the retention waterfall that was in place, which was in Appendix F of this VA servicer handbook. So, what did that leave us? It left us with an incredibly fuzzy standard, which is we didn't have a waterfall anymore. So servicers are to, quote, offer the best loss mitigation option available for the borrower's individual circumstances. That is the standard we have right now. That standard is not clear at all. It's very challenging to figure out what that means. And of course, the word best is very fuzzy. Um, Unfortunately, though, there because of this interest rate issue that we talked about, that I just talked about before, where borrowers who are VA loans, and if they have relatively low rates, are subject to the market rate, and there's no partial claim yet, there isn't a lot or aren't a lot of options available for folks to get reasonable modifications. And so we're back right now without VASP and with no replacement. We're kind of back to this very rough time where there are few options available for borrowers right now. So it's tough. And so the standard of best is not that it isn't that complicated in the end because there's just not much available. So that's where we're at. There is good news, and that is we have a statute that was passed, the VA Home Loan Program Reform Act. So that was signed into law. The problem there is it isn't up and running yet. And in fact, because it relies on partial claims, and we'll talk about what that means, I don't know how you would actually make it up and running without the VA, because we are relying on the VA to provide the funds to make it happen. So while this is great, we are waiting for it to be put up and running. And in fact, I don't really know what to say about that, especially given the status of where we are now. It is a really big issue. But it's worth but let's talk about what it does, because you should be prepared for it and at least know what is coming down the line, even if we don't know when it is coming down the line. So signed into law July 30th. I have provided the link for where the bill text is. And the main thing it does is authorize the VA to create a partial claim program for veterans in default on their VA guaranteed loans. That is the primary thing it does. So it does not replace VASP in the sense of providing a modification. Instead, it has the creation of a partial claim. So for those of you, many of you who are experienced housing counselors, you know what that is, but there may be people who are new. So let's just kind of make sure we all know what a partial claim is, especially in this context. So partial claim is a loan. That is, which is why it needs to be implemented through the VA, because it's the VA that is going to make the loan. So a partial claim is a loan from VA to the borrower to bring the loan current, and then the loan is secured by the property and the amount of the loan. So under FHA's version, that loan is at 0% interest, and there are no monthly payments, and the borrower does not have to pay it back until the end. So what it does in FHA is convert interest-bearing amounts to 0% interest amounts, does not require monthly payments, and does not require, in fact, payments until the end, which either the borrower will be at the end ready to sell the property, or will have to figure out a way, if they have just paid it going forward, or if they refinance it, how they're going to pay it off. So VA, we don't know the precise payment terms yet. Now, there was excuse me. A sneeze is coming, folks, and I don't know when. My
God
cat's
bless you.
walking by. Thank you. Uh, so, uh, so VA, earlier versions of the bill had repayment language in it, and that was pulled out. So we are hopeful that the VA implements it in a way that is like FHA, where it is 0% interest, no monthly payments, and at the end it's a loan. This is going to be some of the stuff that we have to actually work on, because now we just have the statute, we don't have those terms. Um, FHA also implemented its partial claim program in a very flexible manner. We talked about payment supplement. We might talk a little bit about payment supplement here, but we don't know what VA is going to do with that. I believe it is going to be just to bring the loan current. But so what we do know is it is a loan from VA to the borrower to bring it current, and it's going to be attached to the home. We don't know exactly what the repayment terms of it will be yet. So that's what partial claim is. And again, like I said, our full understanding is limited because we don't have the actual guidance yet. We do know a few other things, though. We know that there is going to be some some caps, and of course there should be caps. You can't have, and there are caps in FHA. You can't convert your entire loan from interest-bearing amount to 0% interest. Do it, it is a claim on the guarantee or the insurance. It can't be full, it's partial. So for one set of borrowers, there's going to be a max of 30% of unpaid principal balance as the maximum amount of the claim. So that is, how big can your loan from VA be? For a set of borrowers from about the beginning of the pandemic to about a little before the passage of the loan, that's going to be 30%. For other borrowers, the max and it's going to be 25%. But the real important thing we know as it stands right now by statute is there can only be one statutory partial claim per loan for non-disaster related hardships. You got to burn that one into your mind because it does impact timing. As of right now, in the statute, it says one non-disaster related partial claim per loan. We at NCLC wanted to see more. That did not happen. There is a very open question, I think, about how COVID partial claims count there. And I hope COVID partial claims don't count to that one. So that fleeting program from the pandemic, but it will be up to VA. But we do know in the law that it says for non-disaster related hardships from this statute, there is only one with these caps. So then there is the ability to get an additional statutory partial claim for borrowers defaulted in a disaster related situation. So there's a cap of one for non-disaster, but then there's additional statutory partial claim for disaster related hardships. Again, we don't know exactly how that is going to play out, but we do know in the law there's differentiation between the two. One thing that's going to, I think, get tricky here is that for loans that are in default, as of the date the law was enacted, the secretary can implement it, the program, meaning get the thing up and running through guidance, so not through a long regulatory process. The problem here is that the law was enacted 3 months ago. We don't even have guidance yet. So there may be additional time for law for to get the program up and running for loans that have fallen behind between the end of July and the beginning, or whenever it gets going. So there could be an issue here. Now, some of this stuff could get fixed, but this is just to say, even the standing up of the program, you're going to have to look at some of the details. I'm sure we will train on some of these details because there are tricky things there as well. There's also a 5-year time window, which again, unfortunately, so this is only for 5 years from the date after enactment. Hopefully, this will be successful and become permanent. But for right now, it is a 5-year program. There's some other parts of HB 1815. They do have to create a waterfall. That is a thing that they must do. So it is not just left at the best option. They will need to do some more work there. They did say that purchasing the loan must be last. So if there were ever VASP type thing, it has to be last. At least it confirms that some option could still be possible, though again, we're paused. There's got to be some reports. And also there was an increased appropriation for comprehensive service programs for homeless veterans, which is good. So again, there's a lot there. I wish I had more concrete things to tell you about when it's going to be available. For those of you who are struggling with your VA clients, I'm happy to. I know I have at least one email to get to. I think there's some folks who have been reaching out. Happy to talk through some of these. But again, this is, the stories are important. It's important to share what's happening, especially in this very rough time as we wait VA to take action to put the program in place. So I'm sure we'll have to talk about this again in the future, but I do think it's worth hearing a little bit about it. So I see Ellie popping on, and I know Sun would have a few things to say. So I am going to pass it over to whoever would like to talk first. And thank you all for hearing this update.
Well, there are several questions, but Sun, go ahead and, say a few things, and then I'll start asking questions for both you and Steve to answer.
All right. Thank you. Hello, everybody. Excellent job, Steve. Very clear, it's concise, and it is frustrating. It hasn't been implemented. I just want to make a couple keynotes on that. In the process of the hurry up and wait mode, right? We're seeing lots of frustrations, continued frustrations on in the veteran space as we are HUD counselors on the street level. But I would say it is our duty to understand, right? In depth, understand, take a look at HR 1815, right? Lots of stuff that Steve said, but get really an understanding of it, because when we are at bat, when this goes into effect, whenever that may be, we need as housing counselors to be ready to assist, to represent our the veteran borrowers with the loan servicers, and also with the VA itself. One of the things with VASP that we found was a lot of confusion in the implementation. It was very poorly rolled out in the sense of the VA providing the training, and I'm speaking of VASP and the implementation of it, and there was a lot of confusion around that. So from our perspective, we had to step in and really learn VASP to be the guidance, not only for the veteran, the defaulting borrower, but also in the mortgage servicer space, and believe it or not, educating the VA loan technician as well. So that I would say is a key here for this partial claims bill that will go into effect. And I agree with Steve that hopefully this will be a permanent thing, not a 5-year sunset window on it. There's just one more point I wanna point out on the PCP. It states that the VA must submit to Congress a strategy within 90 days of enactment, ensuring that the veterans using the VA loan are not disadvantaged when securing the loan through a real estate agent or a broker. That's very important for with the the recent NAR decision, right? When I say recent, it was a couple years ago, but the NAR decision and combating every single day of the VA loan, what I call the unconscious bias. Okay, bias with that. So keep in mind, we'll go with that in a further session, but that's a very interesting but yet significant role that this statute gives, and it opens the window for us as housing counselors to step in and finally crack the door in representing and educating the veterans on pre-purchase, on reporting unfair treatment. So that's a very significant point in this, besides the partial claim program itself. And last, I'll leave you with this. 2 points. The partial claim is a good program. It probably will help between 12,000 and about 20,000 defaulting loans. It's projected to help, but there are a lot more loans out there, as Steve was saying, in the default space that needs a version of a combo loan modification to support the partial claim. And I know that's something he and I are advocating for. And please stand by for more of that, because I think when it's going to take a whole group collective to make that happen. And last but not least, I would say right now, there are approximately about 150,000 plus defaulting VA borrower loans. That includes 30-day late, plus the numbers you're seeing are less, and those are, keep in mind, those are 90 plus days and severely delinquent. That's all I have, Ellie, to add. Thank you.
Thanks, son. All right, we do have a few questions. So does VA guidance limit loan modification interest rate to a maximum of 1% increase over the original interest rate? And then there's a CFR notation.
David, give me a sec. Yes. However, that has been the reg for a long time. It has been waived for the most part. The reason, so it's very well intended reg to try to prevent the tripling of interest rates, like I had mentioned, but the problem is the servicers. This has to do with how loans are pooled back into Ginnie Mae securities, and servicers having a disincentive to even engage in any modification that would create a loss for them if they had to repool it. So what you've seen is VA, despite this regulation, allow for interest rates to go above that amount. So frustrating, but it has to kind of do with how the market works. And you spotted it. You can always raise it, but the concern is that they won't make the offers then if they are capped in such a way.
Okay. Okay, so VA partial claim. What happens to payments after May 2025 that are not covered?
Oh, so if I think we're talking about the caps, or the statutory caps. So the May 2025 cap is for borrowers who have a default between March of 20 and May of 25. They are allowed more partial claim than borrowers whose defaults sit outside of that window. So what that means is you can use more partial claim to catch up on arrears. So for larger and larger arrears, it's easier to capture those if you are default within one window versus the later window. The problem is if you exceed, if your borrower's arrears are larger than that statutory cap, there isn't right now a combo modification like someone was mentioning for VA borrowers. So in the FHA side, what happens potentially is you use, if your arrears are larger than the statutory maximum, you can, instead of just having a partial claim to just bring the loan current, you have an option of combining a modification and a partial claim. So you can use some of that partial claim to knock down the balance, the modified balance, and then modify the loan. The one limit here is that this partial claim right now doesn't look like it could, VA partial claim doesn't look like it can do that other function. So if you have someone whose arrears exceed the statutory maximum, you're not able to then say, well, we can use that as a combination in a mod. It's not there. So what's that person going to do? They might have to bring money to the table or something else. So it's I think it goes to, so the caps depend on when you fell behind, and then the upshot of that is you may not be able to bring the loan current, and you don't have a combo mod available.
And if Steve, if I may add to that, it's the reason why I say it's projected to help, of the bigger number, 12 to 20,000, is exactly what you said. So the person, right, you can bring them up to speed, but in plain terms, can they afford the partial claim payment, the amount of payment? Can they maintain, or is that hardship permanent for them, right? To where they're like a real thing, they lost their job. Okay. Obviously, the income is permanently decreased, or they got another one where it's not the same. That's where you need the combo mod option, right? To make it so the best for them. To add to what Steve said, right? The best. Well, the best is probably going to be a combination of both of what the FHA version allows. So 100% of what Steve said.
And I note this point in the chat that combo mods can really lead to way unaffordable payments. The answer to that is they absolutely can. So many borrowers now don't benefit from a combo mod because the partial claim standalone allows them to preserve their pre-hardship, their interest rate, right? So there isn't payment relief there. But why this is important to have is, as we have more borrowers who already have high rates, meaning they got their loans during a period of high rate. Now there's not an increase. It's just, it was high, it is high. And so having a combo mod actually doesn't result in the way high payments that it often can right now. What else you got, Ellie?
Okay, so this is saying the borrower can only be granted one partial claim over the life of the loan, regardless of them not using the total amount?
Yes, that is the problem. There's both a cap and a one-time per. So I was hopeful, and speaking for as NCLC, we're hopeful that a cap would be enough. There's a cap in FHA, but unfortunately, that is not where the law landed. So you do have both a cap and a one-time per use. But of course, you also do have a separate use for disaster. But yeah, it's both a cap and a one-time use.
Well, that's not much fun.
I agree.
Okay, I have a client who inherited a house from her father, which bears a VA loan. She's now in default. She's financially recouped, but She's not able to make up the past due amount. As an heir, is she eligible for any VA loss mit services, or would she have to assume the loan in order to benefit?
So, I don't know what the answer is going to be for partial claim. We don't know how heirs are going to be treated in partial claim. I think what you are going to hope for here is a combination assumption and mod. It's assuming before you know it, a mod is a big risk. And so hopefully you'll see a combination assumption and modification, but that modification is going to be at, again, it depends what the rate is at the loan, but it's going to be in this problem we were talking about with the potential for a big increase. And there's not, and I don't know how VA is going to treat heirs and partial claim. It's not in statute.
Okay. So a couple of people asked a very similar question. Is it possible that during the VA pending mode that the lenders would be mandated to not be able to complete a judgment of foreclosure, especially because there is an approval for the retention measure and that there are so many fuzzy standards?
Yeah, I mean, I think so. We don't have a moratorium right now. So in the time before with VASP pending, while we were waiting for VASP, there was a moratorium on foreclosure. We don't have that right now. I think trying to convince servicers to hold off. I had suggested, I haven't seen this, but if you're working with someone, will the servicer take temporary payment as a type of forbearance? None of these things it's not in there. But hopefully this is kind of files under like, can you get the human element aspect of this to try to get people to hold off while we're in such a horrible situation. I also think, writing your Congress people. I'm not talking about lobbying here. Some of you may be limited on that. What I'm talking about is talking to the constituent advocates at your Senate offices and House offices to say, look at what's happening to my veteran borrower. I think that's really important. Again, you're not saying this is, because some of you are limited lobbying, and I'm not saying that. I'm saying this is about reaching out to elected officials as a constituent to see what kind of help those folks can give you in their in their constituent services offices. I think it's really important. Yeah.
And it's educating. It's educating.
This is educating. Well, it's also problem solving. This is saying like, your constituent has a problem. Can you help your problem? Can you help your constituent? I think that's someone else's son. You were going to say something.
Yeah, go ahead.
I was going to say, from a counseling perspective, what we've done, we need to be prepared to have the tough conversations, right, with defaulting borrowers, whether FHA, VA, or what have you. There's just times where this program is going to be pretty obvious that they're not going to qualify. So it's our responsibility to have those tough conversations and guide them in direction. We just put 3 borrowers. We had that tough conversations, and they have equity in their house, and guide them through that and be there for them life after default. So this program is limited regardless if it gets implemented tomorrow or whatever, right? So that's why I say learn this, and if they're not in a situation where they're not going to be able to keep their home right now, we need to have those conversations. That's it.
Yeah,
there may be people who this doesn't help you.
I just want to remind folks, some of you may not have been doing housing counseling during the financial crisis, but soft landing was a big term during that time, that it's important for homeowners who just cannot manage the payments anymore, especially if they have equity, to sell the house before it goes to a point where it's going to get foreclosed and they're just going to lose all their equity. So that is, as Sun said, as housing counselors, that is one of your mandates, is to help people get the best possible result. And sometimes that means selling the property so that you can get the equity out of it. Okay, I have one more question, and then we'll move on to FHA, which ought to be a lot of fun. So will people with new defaults still be able to get a VA partial claim? Like, is there a timeline on you defaulted at this point, you
Yeah.
can't get a partial claim?
Well, so if they are new defaults, they are going to be in the, like if they default now, they are going to be in the 25% max partial claim bucket with one bite. That's and like and I said, I hope previous COVID partial claims don't count. We don't know that, but assuming this person's never had a partial claim of any type, they've just fallen behind, they're going to be in this 25% max bucket. The challenge is going to be um, what is required from VA to stand this program up. And I mean, I don't, we'll hopefully learn more at the end of the shutdown, but we just don't know yet what that's going to look like. So from the statute, yes, the as long as they're within this 5-year window of the program, you know, if they fall behind now, they're going to be in the 25% bucket. But what is needed to be done in order to get them to actual relief, we are waiting on VA. All right. Well, so I think Ellie, that's all we have on VA. I don't know if Son has any last words you want to say or anything before we get in, or because we will move on to FHA. But I want to just make sure that there's if there's anything else that needs to be said on this.
Hang tight, stay tuned.
There
Fingers
you go.
crossed.
That sounds right. That sounds right.
I have one question of Sun.
Sure.
So I know Steve is very open to getting emails and answering questions via email. So Sun, if people have VA questions that are specific, like, as housing counselors, can we put your email into the chat so folks can reach
Yes.
out to you?
Yes, absolutely.
Okay.
All right. Thank you.
And there is mine too. But mine is on the PowerPoint, but in case you need it. So yes, I am open to that. Okay. Now let us move to something a little less challenging, which is FHA, the revised waterfall, which is in place. So, and we talked about this, like I said, I believe in July. And so, what we want to cover today are your questions and some other questions that I have gotten. They are excellent. And sometimes it is helpful when I have them to questions to put them in here, and we're going to walk through them in a little more detail. So, this section is really going to be a follow up to that. I believe, I think it was said that the previous session that was recorded is on NHRC's website, so you should go and check that out for the first time. But we have a whole lot to talk about because you all had some excellent things to ask about this program, which is no surprise. But first, let's kind of review some of the basic features of it. So the big change is that on October 1st, the waterfall for FHA options, again, the ordering of options was discontinued, and the new waterfall, which is outlined in Mortgagee Letter 2512, became effective. It was a big shift, though, as we remember, much of what's in the new revised waterfall looks a heck of a lot like what was in the COVID waterfall. But at least from a process perspective, we had a whole new process come into effect October 1st, 2025. So again, just as a reminder, for most people, and not just those that had COVID hardships, but most borrowers prior to October 1st, 2025, were reviewed under the COVID waterfall. So not just COVID, that was the primary way system that was used for borrowers. So then October 1st, that waterfall is discontinued. And then the Mortgagee Letter 2512 waterfall became effective. That waterfall will eventually make its way into Handbook 4000.1. Hasn't happened yet. Those few people who were not using the COVID waterfall were those successors in interest, heirs, those folks. They were using FHA HAMP, but that too was eliminated through on October 1st, 2025. And those successors in interest are now in the same waterfall as the rest of borrowers. There is one waterfall now, and FHA HAMP is also suspended. So October 1st, 2025, we have our new waterfall. There are a few particular things for successors, and actually we're going to talk about some of them. But that's the big change. That's why we talked about it in July, to get you prepared for this change, and that's where we remain. So then here's the link for the new waterfall. Again, it is not yet in the handbook. I'm sure the shutdown effect will affect when it gets into the handbook, but you don't need the handbook. You can look at Mortgagee Letter 2512 to see what the waterfall will be. Again, as a reminder, there was a February implementation deadline that is out now. Everything got moved up to October. So if you're thinking, hey, didn't you say something about February before? Yes, but that is now passed. You don't need to worry about that anymore. One key thing is that the 2512 waterfall, as of right now, retains the payment supplement, which is really crucial. And we've talked about what benefits the payment supplement can provide folks. So just a few other, just want to do a few reminders for this process. The big difference between FHA HAMP. So as a reminder, FHA HAMP was the permanent program. The pandemic pushed FHA HAMP to the side, making the COVID waterfall the option. And now we have our revised waterfall. So unlike FHA HAMP, but like the COVID waterfall, borrowers have streamlined loss mitigation access. Really, really important. We are not in a place starting now where there should be a lot of documentation required. In fact, a quote from ML 2512, the borrower is not required to provide financial documentation to be evaluated for a loss mitigation option. The reason is all of these options are no longer based on DTI, they're based on payment relief. So you don't need to collect a bunch of documents to do payment relief, because it's about what the loan was and whether it can be reduced. So the borrower should not be required to provide financial documentation. And in fact, we have what a definition of a complete loss mitigation request. Now, there may be some documents required in some situations, and there is a chart which tells you if there are the type of hardship where you need to provide documentation. But what we're not talking about is financial stuff. Those were the things, the pay stubs, the need to keep refreshing pay stubs, the tax returns. For those of you who are doing this all throughout the financial crisis, you know what I'm talking about in terms of all of this back and forth and deny for incomplete. We don't have that now. We shouldn't have that now. Like I said, there is the possibility for some documentation. We're not talking about detailed financial documentation anymore as of October 1st, 2025. So that is big, streamlined process. That's a big one. There is the need now for a borrower affordability attestation. Talked a little bit about that last time. Basically, there's some requirement that the borrower is going to have to attest that they can make whatever payment is offered here. Now, that can be done verbally, maybe but servicers do have leeway about that, like I attest that I can afford this. Some may want it in writing. I haven't seen one way or another yet if what people are requiring, but this is a new feature of the waterfall. There is the big one, probably aside from kind of how the waterfall works and the streamline, we are now back to loss mitigation limits. So for those of you who are doing this a while, prior to the pandemic, we had something like a 1 in 24, one loan mod every 24-month limit. We lost, that was not there during pandemic waterfall. It is now back. That you have this, a borrower can only receive one loss mitigation option generally in a 24-month period. However, there are some carve outs saying, particular types of loss mitigation options don't count. Now, it does, and we're going to talk about it. It does say COVID option does not count in the 1 in 24. We're going to talk about that in the questions. And all of this is going to be subject to how the servicer reads it. But in general, why it's important is, making sure a borrower isn't going to default right away on an option. So let's say the borrower has not fully recovered, is still in a big time limbo time. That person agreeing to an option can really cause a problem if they say, no, I can definitely do it. They agree to something and then, nope, their financial situation was actually a mess still. And then they fall behind again. That's where this 1 in 24 can really be a problem. And that is why you do is so important. This is why housing counseling is so important, because even if you are not needing to submit financials to the servicer, even if that is no longer needed, that work is still really important. It is still crucial for you all to do your jobs like you do. And this 1 in 24 shows you why. Because if you don't do that and the borrower just says, yeah, no, I can afford it, but then can't, now they're in trouble. So just because the servicer doesn't need it doesn't mean you shouldn't be doing the stuff you already do, which is working with the borrower to truly understand what they can afford. That's why your job is important. So that limit is really the key to it. We have trial plan payments now again. We are back mostly to 3-month trial plans. One addition, though, for those successors in interest, the ones who are Garn Saint Germain exempted, the people who inherit their property or get the property from family members, other Garn exempted transfer. We're not going to talk about exactly what that means, but the point is some of those successors will have to do 6-month trial plans. So most people will do 3, but if you're working with heirs, they may have to do a 6-month trial plan. If you're interested in why 3 for one, 6 the other, you can talk to me. There's some complicated reasons for that. But the point is, most people will have to do 3-month trial plans, meaning you got to make 3 payments to show you can afford it before you get the actual option. Some people will have to do 6-month trial plans. And then there's a helpful waterfall chart, which you should check out. It is a clear way to just kind of see how these options are ordered. So that is the recap. Let's go through your questions, and there will be time for questions at the end. So the first question I got, which I think is really good, someone on this asks is, can you talk about the availability of forbearance now and going forward? So a reminder, forbearance are temporary pauses in the borrower's obligation to make monthly payments. So these are not, we are bringing the borrower current. These are, we are pausing And then we are going to have to resolve the amounts due later because these don't involve cancellation of amounts due. And so these are really important for those borrowers who are, like I was talking about before, that person who thinks they can do it, but you've looked at this and they have not recovered yet. Maybe forbearance is the thing they need to do in order to fully recover to then be successful. So there are some big changes here. So before the pandemic waterfall, you needed to do a full loss mitigation application. And actually, there needed to be some unemployment involved. And in fact, some servicers were saying you had to have unemployment insurance to be eligible for a special forbearance. That was some people's reading of the guidance prior to the pandemic. That was special forbearance, and there was a cap on arrears of 12 months unpaid. So that's where we were. And then during the pandemic, we had a very liberal forbearance policy and some fluctuation, right? There were some people who could get 18 months of forbearance, even if they were way behind on their mortgage already. Some people didn't have to document any forbearance, lots of people didn't. And you just really had to do a more streamlined verbal attestation of unemployment. So that was where we were. Pandemic, really prior to the pandemic, pretty tough. Pandemic loosened it up. So now we have the revisions in the waterfall that incorporate streamlined forbearance principles and get rid of full financial applications, which I think is really helpful and should be really good for borrowers and a big change from what was prior to the pandemic. So now it says the borrower can get forbearance if they attest they have an unresolved financial hardship, you haven't started first legal action, and you can't have arrears of more than 12 months delinquent principal and interest. And that's the cap, right? The maximum forbearance is going to be you can't have forbear more than 12 months PITI, depending on how you chop it up, right? So sometimes you can do partial, but the point is it doesn't require a application, and you still have that 12-month cap. But the point here is to really give the borrower space to see if they have resolved it. And then if you're, getting on that, you got to figure out what the permanent loss mitigation option is. So forbearance really has changed, and I hope it will be an effective tool, especially given that we do have that 1 in 24 cap happening. And this will be something I think people will need to go and use. So that's a positive change. The next question I got, so that's forbearance. Next question I got is, well, okay, in this 1 in 24 month analysis, how does a trial plan count? And I will say as an aside that the 1 in 24 language, I do think you just need to have. I think it is kind of complicated. I read it in a particular way, but it's hard to know how servicers are actually going to read it themselves. So you got to have the language available. But the question was, how does a trial plan count? So I would break this down into two categories of thinking how failed trial plans can impact the 1 in 24. So in the first case, you have a borrower who fails a trial plan, but then brings the loan current without a modification. They failed it, but they bring a loan current. Maybe they've reinstated or accessed a half program or something, but then they fall behind again, versus the borrower who failed the trial plan and doesn't take a step to bring it current. So how do those work? So in the first category, I don't think a failure itself causes a 1 in 24 issue, because if you look at the language, it says the borrower has not it must ensure the borrower hasn't executed a permanent home retention option in the last 24. So just failing a trial plan, but then you bring it current without a permanent home retention option, I don't think that that counts against anything in the 1 in 24, because the borrower in this case, the servicer is making sure the borrower has not executed an agreement for a permanent hardship option. So if they have, there's a problem. But if they have not, I don't think a failure of the trial plan should cause an issue. And actually, kind of the same for the second category. Because if the borrower fails a trial plan, but then doesn't bring it current and still is active, there is actually a separate section of the guide about what you can review borrowers for once if they have failed a trial plan, including reconsideration of loss mitigation options. So in either case, the case where the borrower has a trial plan, fails, manages to bring it current without a permanent retention option, and then applies again, or the borrower who fails, uh, brings it current and then falls behind again, or the borrower who just fails a trial plan and is now left. I don't think there's a 1 in 24 issue there, but I do think it's a little complicated, and I think you kind of have to piece all of the puzzle together. So I think the punchline is this language about the 1 in 24, which is quoted. I think this is going to be really where we are going to have to see how servicers read it, and B, I think really closely follow what the language says. But then someone else had a question of, and I think this is a big one, does the 1 in 24 apply only permanent options? But then what about a borrower who used a partial claim under the COVID waterfall? Are they disqualified from a post-COVID waterfall, from the new waterfall option if it's from the 1 in 24? So I read this as saying, if a borrower received a COVID option, they still remain eligible, that the COVID option doesn't cause a problem, because a borrower who received a COVID, it says right here, a COVID option in the last 24 months remains eligible for a permanent option. So I think that even if it's really close in time, the borrower should still be able to get the COVID option, or sorry, the borrower who had the COVID option should still get the permanent option. One complicating thing is in the chart, though, there's some shorthand in a chart, and it doesn't say COVID in that chart. And I've heard at least one servicer kind of call a question there. But I think the language is pretty clear. And I think that's really why you also need to understand what was done under the COVID option, or what was done in the post. But the other thing that they could read this is saying, like, a COVID option, it only counts as a COVID option if it's pandemic related. I don't think that's what the language says, but so I think, and this will be something that comes up, the borrower who had the COVID option and now falls behind should be able to get under the revised waterfall, but I guess we're going to see how that works out. Ellie, maybe time to pause and ask questions.
Yeah. I'm jumping in because there are a bunch of people asking
Okay.
the same question about trial payments. So essentially,
Okay.
the question is, what if somebody misses a trial payment and they have a good reason for it? Or even if they don't have a good reason for it, does it make a difference? Are they able to reapply within 24 months? There's
right. So that's what I'm saying.
People asking this question.
So the trial plan payment itself, failure, should not cause a 1 in 24 issue. You have to then, based on kind of how we walked through, because the trial plan failure is different than the failure of a permanent option. Once I sign the modification offer, then you're going to start getting 1 in 24 things. Trial plan failure is different. There are handbook provisions. There's actually kind of a lot of discussion in the handbook and in the mortgagee letter about what a servicer is to do with the borrower who fails a trial plan. It's a little too voluminous to cover in a question and answer section, but you just have to read that section of the ML to see what a borrower can be reviewed for if they fail a trial plan. But the failure of a trial plan, kind of as we walked through, doesn't cause a 1 in 24 issue. It could cause another problem. If the servicer says, I've looked at the post trial plan failure sections of the handbook and you don't fit in, that could be an issue, but it's different than a 1 in 24.
Okay. And I'll just say somebody commented that servicers should be required to tell homeowners what happens if they miss their trial payments, because if the homeowners knew, they'd probably be much less likely to fail those payments. And
Yeah, and
somebody was also commenting additionally about servicers aren't really doing a good job of explaining how a forbearance actually works.
yeah. No, I think this is why what you do is important. I think understanding, like, a trial plan failure can have a consequence, right? You just because there are handbook sections addressing what can happen there doesn't mean you're going to be eligible for it, right? Like, you have to read the separate sections there. So it can cause an issue, but it's different than a 1 in 24 issue. But you might be opening up a whole series of other problems, which is why you want to do what you do, which is you don't want your borrower to agree to something that, you know, in this waterfall where you want your borrower to fully understand what is the deal is. You want to make sure they have recovered, because failure can be a problem if they sign a permanent modification offer. And you want to understand how to walk through this streamlined process with them. And there is that, can they afford a payment, or do they need a payment reduction? And then they're going to walk through that. Like, you want to understand your borrower situation before you enter into that streamlined process, because making the wrong choice can have negative impacts. I mean, again, things can be fixed, but it is important to understand with the borrower what the realistic situation is. And I totally agree with the comment that servicers surely could do a better job. And unfortunately, that's true, and why your jobs are so important.
So there's a ton more questions, but I think you have more to present.
Okay. Well, I have a few more. I have more questions to cover. So the 1 in 24, it is complicated, and if you need help with this one, let me know, because I can talk you through it. But it's really going to be a really important part of this. Trial plans apply to standalone partial claims as well. Yep. Definition of a permanent home retention option includes a standalone partial claim, and one of the eligibility requirements for permanent home retention options is completion of a trial plan. So your trial plans are going to be required even for standalone partial claims. Again, this is a departure from what we saw in the pandemic, but kind of back to where we were. Can successors and interests take advantage of a partial claim? Meaning, can successor get a partial claim? And I see this as yes. I think this one was asked live to me, and it was a little tricky, but I got there. So mortgagee can consider home retention options for a non-borrower who is a successor through Garn St. Germain, who is an heir to the property. The rules for doing that are: you got to assume personal responsibility, you got to occupy the home as a principal residence, you have to meet the criteria for loss mitigation, and you have to complete a 6-month trial plan. But I don't see any exclusion saying you can't get a partial claim. You're just going to need to sign personal liability and then do a partial claim. So I think successors should have access to partial claim. The key is going to be completing that 6-month trial plan payment. Had a question about what is an OWL. This is another new feature of the waterfall. So let's talk about the OWL. That is the outside of the waterfall loan modification. We did not, I think, have time to talk about this. So it is a permanent modification for the borrower who has been unresponsive. So this can be either a 30 or 40-year modification that is sent out to the borrower without any request. In other words, for the borrower who is unresponsive. Why this matters is you may be looking at, your clients may be asking, or you may just see this, and I wanted to let you know that it's a real thing. It is basically for the borrower who has not been responsive to outreach. There's been no final documents sent. And then why this will be sent is if a OWL at the market rate can provide at least $1 payment reduction, then it can be sent out. Now, probably I don't see there being any benefit of this kind of offer as opposed to walking through the waterfall. When you walk through the waterfall, you can really answer the questions and calibrate what would be better for the borrower to have. So I don't see this as you don't do anything and you wait for the owl to come, which is funny. I guess it's like a bird. No, I don't think that's why you're going to want to know about this. I think you're going to want to participate in the waterfall conversation. But I think it's important for you to, as you were talking through the borrower, you may see this or this may come up. So I just want to make sure you saw that there is this still option where the servicer can send it out without the borrower asking. I am now, it was the ALM before in the COVID waterfall. Now it is the OWL. But I don't think, what's important here is I don't think this is going to be something, you're not asking for this. You're following through the waterfall and going through the streamlined process, but you may just need to know that this is out there. So that is what an OWL is. I think we're almost out of these questions. I know you have more. This is important though. Are there going to be any seasoning requirements? Is the borrower going to have paid 4 monthly mortgage payments since the loan was originated? There were stricter seasoning requirements in the pre-pandemic. And what I want to say is, yes, there are seasoning. We still have, the borrower has to have paid 4 mortgage payments, except for disaster home retention options. So there is a seasoning requirement of 4, but there used to be another seasoning requirement. There had to be 12 months on the loan. I don't see that one as much anymore, but these are the requirements, some of the requirements, and you do see a minimum of 4 mortgage payments does need to be made. So we do still have at least that seasoning requirement, meaning the loan has to have been at least that old. So the borrower can't have made less than 4 mortgage payments to access lost MIT unless it is disaster. And escrow shortage. How is any escrow shortage handled in payment supplement? There are provisions on escrow for permanent loss mitigation options. What you'll see is that in the option, in the how to address arrears section of the new waterfall, the servicer can include both advances for escrow and a projected shortage amount into the arrears. Now, this is better than Fannie and Freddie's options. So just a reminder that servicers, when they are calculating arrears needed to bring the mortgage current, should not only include money they have sent out for escrow, but also any shortage amount. And then they need to, before issuing a trial plan, do an escrow analysis. So that, I think, is a major thing to check on, to make sure servicers are doing, is they should be addressing, for FHA borrowers. The rules are a little different for others, but for FHA borrowers, they should be doing an escrow analysis, and they should be accounting for escrow shortages in how they calculate it. But I do think this is a place where we see issues. And I do think this is something where you're helping out by sort of understanding, asking questions when you're receiving a trial plan. Ask, what is the escrow on that? Is that covering escrow? I think those little things about making sure the escrow looks right can really avoid problems going forward. And then, so I think, keep doing what you're doing on escrow. The other question we had is, can a borrower qualify for a partial claim if they have a second mortgage? I know we got that one. And the key is there is no lien priority for filing of a partial claim or a payment supplement. So should not be an issue for payment supplement or partial claim if there is a second mortgage. And then on effective date, I think this one, basically, if you applied before 10/1 and the servicer doesn't process the app, I think the key is if the mortgagee has sent out the final documents. But I see that we're at 12:43, so that's one of the ones that you all have covered. But Ellie, I think it may be now time to switch. And I will be sending this out. I will tell you one thing. I did make a few changes because I do that. The other one you have that NHRC sent out, it's got most of this, but I did make some edits. So I will resend that and you will get the edited version. But I think now we should take the last 15 and see what people have on their mind from what we've been talking about.
Great. And I will just let everybody know that we will, when we send out the recording and the link to the PowerPoint presentation, we should be able to send the updated PowerPoint presentation with Steve's new stuff in it. Okay, so there are a bunch of questions around what's the deal with Fannie and Freddie? Do they have to streamline? Are they doing anything? What are anything that you can share?
So Fannie and Freddie, I think, are pretty stable. So you have their flex. And flex also, there are some different, there are still requirements to submit the form, but for the most part, flex looks like it is a payment reduction option. So flex sort of works a lot like FHA, where the relief is not determined based on a debt to income ratio, but is instead works on a payment reduction model. So the key about flex, and I just saw pop up a point that flex is great. The key about flex is Fannie and Freddie allow borrowers to keep the rate they have, even if it is below the current market rate. So we have seen fewer issues with flex because you don't see this rocketing rate when you need a payment reduction or when you need a modification. Now, FHA has the payment supplement to help curb some of that, but there's some benefit to flex. So, and then the other part of flex or Fannie Freddie that's a little different is the deferral is capped. So unlike a standalone partial claim, which can really be quite large, the deferral is generally capped to 6 months. So if you don't have someone who needs longer term relief isn't going to just get that thing that brings their loan current and And that's it. They probably are going to go through Flex. So I have not heard any issues, suggestions that Flex is subject to change. Of course, we're in a challenging political environment, so or where we're in the middle of a shutdown. It's hard to predict where things are going, but I have not heard issues with Fannie and Freddie Flex, and hopefully, and I haven't heard of it in the conversations around getting the Fannie and Freddie out of conservatorship. And I know Fannie and Freddie spent a lot of time working on it, so hopefully Flex just stays as it is because it does provide relief.
And is that streamlined?
So kind of, I would say my understanding generally is that still they are requiring Form 710, but I think it's been less burdensome than FHA, and you do get proactive Flex that can be sent out without an application. So it's not streamlined to the full extent FHA is, but I don't think the issues have always been a little less than when we had FHA loans before and you had to submit.
Okay. Let's see. FHA waterfall. Will the lender be allowed to take financials over the phone when applying for a modification workout?
So again, there will not be financials over the phone.
It sounds like that's being asked though. There's a few people
What will
who
be
commented on it
asked.
in the chat, and yeah, okay.
So right. So there's a few things going on here. Sure. For one, I'm just telling you what the policy is. What servicers are actually doing is tricky. And if we had if you had the access to the National Servicing Center, it would be a lot easier. I'm not sure how easy it is to get into them. So instead of submitting financials, the conversation should be about, can a borrower afford to resume their current payment or their pre-hardship payment, or do they need payment reduction? And there's a few, so that should be what this is now. And again, this is effective as of 26 days ago. So, do I think that there's probably a lag? Sure, but this should be getting more and more right as it goes. So there shouldn't be collection of payment information, at least as of October 1. That does not mean you should not be doing this homework in advance, because the decisions borrowers make are really important. They have to be able to make sure they can afford a payment. And if they're going to struggle, then and they're going to fall behind, then it's a real problem. On the other hand, if the borrower can afford it, and there is something simple like a standalone partial claim, there is a real benefit to not obtaining relief, right? Because if you say the borrower is going to need, I'll just get borrower payment relief. Well, if you max out the borrower's partial claim and get a reduction in payment, but then not a 1 in 24. So there's a 1 in 24 issue, it could be, but there's only a 30% cap on partial claim, right? There are limits to how much you can get over the life of loan. And so if you have the borrower go into something they really didn't need, and they use up all of the options they could, well, then if they fall behind later, they're not going to have any partial claim available because they used it all, even though they didn't need it. So that is to say, no, you're not. You should not be submitting financials. And I'm not saying servicers aren't doing it, but they shouldn't be as of October 1st. But you should be preparing for those conversations and doing what you're doing to help the borrower understand what the options are and what's really best for them.
Okay, so there's a few questions just clarifying, like, for real, it's only 1 in 24 months. For instance, if somebody gets approved for a lost MIP because they could afford it, but then they lose their job,
I know.
they're out of luck. That's the case?
Yeah, I mean, that's the case. And we at NCLC pushed for better than 1 in 24. We did not get better than 1 in 24. You're going to think about forbearance in that case. You're going to think about making sure the borrower has, thinking about reserves, thinking about those things. And then you're going to really read the 1 in 20 language as it comes in. But and I certainly in my legal service, as a legal services lawyer for a while, I saw some rough 1 in 24. Just saw a comment pop up about hardships 1 in 24. I know, I agree, but we do need to think really carefully about the 1 in 24 and how that fits in, and then really make sure, as it comes, we're going to get better understand. We're only 29 days into this new waterfall. We're going to get a better understanding of how servicers look at it. But for those of you who are working with borrowers now, you need to understand that that's out there. So
And then
it's critical.
one other clarifying question, does that mean, what if somebody was offered one, but they didn't accept it? So is it?
Yes. So that's what I was. So I read that. I read that language as I read that language as saying, I'm going to go back to it on my own screen. I'm not going to bother to do it. Where to go? I see executed an agreement for.
Okay.
So, I mean, we'll see what servicers say, but executed an agreement for sounds like signed the thing and sent it back. And that's what I was saying about why I don't think trial plan failures fit in, because you fail a trial plan, but then you bring it current. People they cash out their 401k, or they do stuff to bring the loan current, borrow money from family, and then they fall behind again. Same thing. I don't see the failing of a trial plan is not executing an agreement for a permanent option. We'll see how this works, but that's my read.
Yeah, and I don't know if you see in the chat, somebody just said servicers are declining people for FHA all the time due to TPP failure or never responding to the original offer. At least the servicers that they are talking to.
Right. So I think like there are a few. Okay. So this is going to be interesting how that works. So you do want, if it is like borrower failed a trial plan and you're helping them, you do have to read, and again, we can maybe do a separate, there's too much there. It's a big 251-page document we have to cover. So you're going to have to look at, there are rules, I'm telling you, in ML 2512 about what to do with the borrower who failed the trial plan and when they can get reevaluated. Check those out. But that's not a 1 in 24. You just have to read the guidance about that. And sometimes you may have to say it's like a change in circumstance. And anytime, again, I wish, hopefully the National Servicing Center will be back up and running. If it's not fully, my understanding is it's been a little tricky to get, if not impossible to get anything out of the National Servicing Center. But, when it is up and running, those like FHA not allows it ones are the great ones to escalate to the NSC. Sometimes servicer says FHA doesn't allow, and it's not really FHA not allowing, it's servicer not reading it right. But of course it's tricky right now because,
and that was what I was going to add. Like, you, in many cases, housing counselors are probably more and better educated about mortgagee letter 2025-12 than the person on the other end of the phone.
That's right.
So stand your ground, know that you're smart enough, and make sure that you advocate accordingly. Like, what you see, what you read, make sure that they are understanding that what you're talking about. Okay.
And NHRC does provide those excellent, and you all, just to plug NHRC, provide excellent, have escalations within servicers. And this is often the kind of thing you want to use them for.
Yeah. Okay, so here's kind of an interesting question. This person is in Florida, so it's pretty pertinent there, and it is, more and more pertinent across the country disaster-wise. But with the increases of insurance, what happens If a client falls behind and they apply for loss mid-option and their insurance amount increases twofold, how can
Yeah.
you modify the loan to an affordable range?
I mean, it's hard. Um, so modifications are generally to the principal and interest portion of the loan. All of the payment relief, um, all of the payment relief parts to loan modifications are not to PITI anymore. They're to P&I. So um, P&I is, of course, principal and interest. And so you modify principal and interest. That does not solve the challenge of um, the challenge of an increased insurance. It's very tough. I think planning is probably your best bet here. And that is, helping your client understand their market options and making sure the client is getting escrow. I just saw in the chat. That's why it's important to get escrow done. You do need to get escrow analysis because you got to at least know, right? Even if there are some realities you can't touch. I can't solve I'm not here. The crazy happening in insurance, especially in Florida, is kind of beyond the scope of what I'm doing right now. But I think what you can do is making sure that at least it's set up for as much success. And I think making sure the escrow analysis is right, making sure you understand what they're helping them understand what their insurance costs are. But it's not going to solve everything. It's not.
Okay, let's see. The 1 in 24 is only applicable to the mods, right? Not to the partial claim.
Nope, it is partial claim. No, it's partial claim too.
Oh, okay, well,
Permanent home retention option.
all righty.
Used to not be. That person probably was doing this before. Used to not be partial claim, but now is. No, covers both.
Okay, let's see. I don't understand why successors get 6 months versus 3 months. Could you explain?
It has to do with statute. And again, these are successors that fit in this special category of Garn eligible, Garn St. Germain eligible. I think Sarah's talked about this on this. These are particular classes of successors. We're kind of lumping them together because it's tricky. The reason they have to do 6 has to do with how an FHA statute reads about successors, and there was nothing to do about it. They're just going to have to do 6 instead of 3, and it has to do with deep weeds of the FHA statute that Sarah Mancini from my office would have to explain it to you, but I do know that they're going to have to do 6.
Okay. Can you talk about the legal fees HUD has deemed customary and reasonable to charge for a foreclosure? I see 6,000 for just filing a foreclosure complaint. How do we?
Uh, that's a great question. There was I think it's in the handbook, 4000.1. I can't remember where it lives now, but you should try to find through HUD guidance what reasonable and customary is in your state. And you do want to know that. I think it's attached to handbook 4000.1, though I don't remember. And I've never thought about like advocating about whether those are too high or too low in a particular state. Could be something you do, but you do at least want to know what HUD says. And I think it's in the handbook.
Okay, I'm going to do one more question, and we're
Sure.
over time, but this one I think I really want to hear the answer to. So, do
Sure.
servicers have to put COVID-19 on partial claim notes because New Jersey is starting to assist with COVID partial claims, but denying it if it doesn't explicitly state COVID-19 partial claim?
I don't think so. That's a great question. I mean, so we talked about this, in terms of statutory maximum, the max amount of partial claim is 30% of the unpaid principal balance of the loan at the time of the first partial claim. There's no COVID, there's no extra for COVID. It's not like VA. for FHA, 30% is the most you can pay, and you have to record partial claims. But I don't recall seeing in the partial claim documents a notation that it's a COVID partial claim versus a not. The borrower's approval forms would have that, but I don't know. Maybe I'm missing something, and maybe it was in there, but I guess so I could be wrong, but I thought that they would just be your standard partial claim form, and that would be recorded, and then your max is 30% regardless of what you call the program. So it might be worth reaching out to folks in New Jersey, though. I've never heard of that, and I don't know the exact answer, but that's my guess.
All right, and I'll just make one more plug, not a question so much, but Mary Jones points out for escrow, make sure that the homeowner has applied for all tax exemptions, property
Yes.
tax exemptions. So,
Excellent point. Excellent point.
okay, well, Steve, thank you once again for an amazing
My
webinar.
pleasure.
And I'm going to very quickly hand it over to Bruce so he can close us out.
Thank you, everyone. It was great.
Yeah, thank you, Steve. Terrific. And thank you, Son. And don't forget to join us next week for the military.